Welcome back to another Meet Kevin report. We make sure we've got everything cooking right. It looks like we should be okay, but I will make sure. There we go. This is looking very good. All right, welcome back to the studio and me, Kevin Report number 71. It's crazy to think we're already in the 70s. Obviously, quite a bit to talk about this morning, specifically regarding oil and some other fears that are cropping up in various different places. So we'll talk about all of that. I'd like to start by taking a quick check at what's going on with the 5 year break evens. Yeah, as expected, unfortunately, they're moving up again. This is generally a bad leading indicator for what's going on or what could be coming with our good friend J Pow. So hopefully we can maintain the lead. But in the meantime, yeah, take a look at this particular chart here. This is our 5 year break even. And unfortunately, this one's definitely sliding up a little bit. Looks like we had a little bit of a banking crisis relief here. But now the 5 year break even is moving up again. Why is potentially the 5 year break even moving up again? What the heck does that even mean? Well, let's talk about exactly that. So, the oil crisis. The oil crisis now and massive oil price cuts are probably exactly what are leading oil or in 5 year break even inflation rates to start skyrocketing again. 5 year break even rate, remember what this is. This is a difference between inflation protected securities and yields on the 5 years. Okay, that might not sound like English either, but basically, the higher this chart goes, the more angry Jerome Powell generally gets. So this is why over here in February, after that hot January data we got, these 5 year break evens really ran away, and the Federal Reserve had to get quite aggressive, really Fed speaking us into this idea that, hey, we're going to go a lot higher for longer. You know, we said 5.1%. Remember what J Powell said on February 1st and 2nd? He says, hey, we said 5.1% as a terminal rate in December. Yeah. If I had to redo those numbers now, I'd revise them a lot higher. Partly because the break-even rate of inflation was started to skyrocket. And now, even though we just had good numbers on the break-even or on PCE, which is the Fed's preferred inflation gauge, why would this particular chart be skyrocketing? Why? Why would this be going up? Well, it's of course now because we've got OPEC Plus cutting oil by over 1 million barrels of oil a day. Now, yes, we have countries like Brazil, Canada, and Norway, and the United States trying to increase production. But I just want you to understand the difference here. Brazil, Canada, Norway, and the United States are trying to increase production to the tune of 100,000 barrels per day. OPEC Plus is now trying to cut production by 1 million barrels per day. Why is that? Well, basically, because they want more money per barrel of oil. That is the whole point of OPEC, to try to maximize profits for oil producing nations. Instead of driving prices straight down, the idea is let's get as much capacity as possible and basically print barrels when prices are high. If prices fall too low, then let's just cut production together and prices will go back up and we'll all make more money per barrel of oil. Unfortunately, that's quite inflationary. Now, one of the reasons these cuts didn't come sooner is because oil hadn't been falling that heavily. I mean, beyond the bubble of sort of that crazy peak in the 120 barrel range that we saw when Putin invaded Ukraine. Oil's kind of been bobbing around relatively decent levels. However, in this last quarter, oil plummeted and it had its worst quarter since April of 2020. That's pretty extreme. In fact, oil fell as much as 7% just last week, which is pretty wild. Part of that had to do because of actually, let me rephrase that. Rephrasing, oil had its worst quarter since April of 2020, but last week we did have some drama that actually it didn't fall last week. We actually had a little bit of a rally last week because of the drama between Iraq and Turkey. Those exports are expected to resume. That is, some oil exports were paused in the region there, leading oil to actually already run up 9%. Now it's moving up another 6% on top of that. Maybe if that oil production continues, maybe we'll see that kind of 9% rally go away and sort of extinguish that 6% that we're seeing today. But the point is, a lot of news coverage is focused on what OPEC Plus is doing, not necessarily just what's going on between Iraq and Turkey. Why does that matter? Well, much of oil pricing has to do with speculation in the futures market. Why is that important? Well, it's important because if people again start trying to believe that oil is going to go to $100 a barrel, we'll start seeing that pricing into the market. Now, we might not actually make it to $100 per barrel, but you do tend to start seeing that trend towards it. Right now, Brent's at 84.43 and WTI is basically at $80. Seeing Brent move up another $10 to $95 on these oil OPEC price cuts, possible. And the problem with that is, as oil rises, inflation expectations, unfortunately, go up. That's why we're seeing this spike in the break evens. Because the financial crisis woes started fading away. The fact that, oh yeah, the banking crisis for sure was going to destroy our economy. That seemed to have been a little bit more of a passing moment here, this financial crisis. And hopefully the riskiest banks have now gone through their pain, and hopefully there aren't any other Silicon Valley banks out there. Hopefully. But then again, remember, hope is not an investing strategy. So you could always expect for more of a banking crisis coming. But this surge over here in break evens today, really this surge on the right over here, is clearly because of the oil price cuts over at OPEC. The oil production cuts. And it is inflationary. It's absolutely an inflationary impetus. In fact, let me show you a chart. And this chart is pretty neat because this chart basically lines up inflation and oil prices, and it's pretty obvious. So if I grab this chart here from JP Morgan, pop it on screen right here, what do we see? US CPI, which is obviously our inflation gauge, and Brent. That is the international blend of oil, not to be confused with WTI. When you hear WTI, just think Western, Western. And then also think win. And when you think win, think how you could win 12 free stocks with Webull by going to metkevin.com/free. Sponsored. But anyway, okay, so CPI and Brent, what do we have here? Percent year-over-year gains. Okay, so this is a chart of year-over-year gains, and it looks like Brent is the first line over here, the black line, that is, and you see this pretty clear correlation. In some cases, it actually looks like the black line goes up first, and then inflation goes up. Now, keep in mind, this is not core, so it makes sense. Energy is obviously a big part of headline inflation. So it does make sense that you see the black line move up, and when it moves down, CPI could potentially come down. So they're not perfectly, it's not perfectly clear that one leads the other. I think many of us will make the argument, though, that obviously if oil prices go up, inflation is going to go up. And look at this. Oil prices have come down and inflation has come down. That's great. But what happens now if, because of these essentially production cuts, inflation ticks back up again? Well, then we're stuck with the higher for longer regime of the Federal Reserve, and maybe we have to start undoing some of the price cuts of the interest rate hikes that we're expecting for the Federal Reserve. Markets have started, after the banking crisis, pricing in that the Fed's going to cut rates as soon as June because of the banking crisis. And after they cut rates in June, then by December, they'll have ended up cutting a cumulative 100 basis points, which is essentially 1%. So a start of a 25 BP cut potentially in June, and then thereafter more cuts. That's been heavily priced in because of the banking crisis. But if the banking crisis is a nothing burger and we go back to worrying about inflation, and inflation then gets accelerated by oil price cuts, then we end or oil production. I keep saying that wrong. Oil production cuts. Then we end up having larger problems. And we're not in the kind of market right now where we really want larger problems. Now, so far, even though oil prices are generally speculative in terms of futures pricing, so far, markets aren't reacting too terribly. I mean, some tech stocks are down a little bit more than you'd expect. Tesla's down. NASDAQ's down about 0.6%, even after Tesla smashed its delivery expectations, which we'll talk about separately. But really, I think the fear now is, okay, banking crisis gone means maybe less chance of Fed cut, maybe time to sell. But then again, positioning in the stock market is already terribly low. I mean, consider the data we talked about yesterday. Bank of America told us that positioning in the stock market is at an 18-month low. Bank of America also told us that cash positions are at a 3-year high for individuals. Goldman Sachs says people haven't been this little allocated to stocks since the beginning of the 2000s. So in other words, potentially somewhere up to a 20-year low allocation to stocks. And Goldman Sachs surveys suggesting that 85% of their clients are either bearish on stocks or neutral on stocks. And that's leading them to say, where are the bulls? So on one hand, a lot of this seems like it would be bad news if we have more inflationary pressures and we have to start undoing the rate cuts we're pricing in. Maybe stocks should fall. But then again, if stocks have such little allocation and people are already so bearish on the market, is it possible the market can hold up? Well, if we use Bitcoin maybe as somewhat of a leading indicator, Bitcoin doesn't seem to care that much. Now, what's remarkable here about Bitcoin is it has been sitting at this 28,200 level, which is one of its Fibonacci retracement lines here off of the low of 15.4. This is actually a fantastic sign that maybe the fears of this oil price disaster are a little overblown. Not entirely sure, but it's a good potentially indicator if you believe that Bitcoin pricing is reflective of maybe more of a market pricing. You have an open order book 24/7 rather than sort of more of a market-based timing when you're just in the stock market. Even though we have pre-markets and after markets, liquidity is so little in the stock market. Sometimes Bitcoin can be a good indicator, and this would not be an indicator of fear. Though Larry Summers says we have a 50% chance of repeating the banking crisis. This could obviously lead to fears that at the same time as a new banking crisis, we could end up having sticky inflation. We could even be in an environment where we're still doing and conducting quantitative tightening while at the same time cutting interest rates, which then you wonder, okay, well, which is going to be worse? And it's possible quantitative tightening could be worse. You could have low rates and a tightening cycle, and it would be somewhat confusing to markets because not even markets understand. And anytime there's, or what would happen with the Fed itself doesn't even know what quantitative tightening will end up doing to the economy. And generally, when there's confusion in the stock market, stocks tend to go down. So that'll be quite interesting. At the same time, you've got the European Central Bank warning, look, now we've got inflationary concerns that could end up being sticky. We've got some financial woes. And on top of that, the real estate fund market in Europe has tripled over the last 10 years. It's a $1.1 trillion market. And if there's any kind of surge in redemption requests, which we've already been seeing in America, then you could end up seeing an increase of housing inventory and commercial real estate inventory, leading to real estate pain, which potentially real estate pain could lead to consumer pain. As Robert Shiller told us, it's not actually stocks going down that affect people's spending. It's actually real estate spending or real estate net worth that affects people's willingness to spend. That's scary because if that's true, then that means the real pain is still ahead. That means the real estate price pain is still ahead. But if that real estate pain comes to fruition, then we actually get the real EPS pain. EPS pain is, of course, what Morgan Stanley's Mike Wilson has been pounding the table about for months, suggesting, hey, whoa, we're probably going down because once those earnings prices earnings forecasts for companies actually come in, accurately based on the spending we're expecting, and people have run through the amount of excess spending savings they have, then we're going to face real problems. That's sort of been Morgan Stanley's point of view. And it's not only just him, it's also other writers over at Morgan Stanley. Here's another piece from Morgan Stanley just out this morning. And they're talking about, given the events of the past few weeks, we think guidance is looking more and more unrealistic. And equity markets are at a greater risk of pricing in much lower estimates for earnings ahead. This is typically how bear markets end, i.e., PE multiples fall precipitously and unexpectedly, catching many investors off guard. The recent underperformance of small caps and low-quality stocks suggests this could be imminent. I mean, now you've got Morgan Stanley basically saying there's an imminent, massive stock market crash coming, and the oil price cuts and fears around inflation start that. With the uncertainty of whether or not we're going to get more of a banking crisis. And now you've got too many indicators lining up for Morgan Stanley to be happy over here, suggesting, hey, we're going too fast here. The inverted yield curve has never been wrong before. Why would it be wrong now? And this is actually something that JP Morgan reiterates as well. Let's go back to that JP Morgan piece here. And if we go to their chart of the inverted yield curve, which you're probably already familiar with this, consensus view for a soft landing, but the yield curve thus far has never been wrong. I suppose then the question is, okay, well, who says, a soft landing can't just be a little shallow recession, like a little baby recession? But then the question is, Well, is a baby recession actually going to be enough to get inflation down? That's the big question. Because if you can't get rid of inflation, then you end up with higher for way longer, and that's something that nobody's looking forward to. So, how do we reconcile all of this? Well, look, I've been of the mindset pretty heavily that the best way to get through this is with pricing power style stocks. And a Goldman Sachs analyst here, I think, made an interesting point. They actually wrote here a bull case for tech. And they talk about basically how if there ends up being growth scarcity, that is, if the market overall ends up having less growth, and that is basically companies that are staples, defensives, oops, spelled that wrong, defensives, real estate, healthcare, and utilities. If these and even some discretionaries, if these slow down and we end up having a growth scare where all of a sudden a lot of the S&P 500 stocks are actually starting to suffer, what could do well in a low growth environment or a slow growth environment? Well, Goldman Sachs goes as far as suggesting it's tech. It's actually tech. Tech is going to potentially be that survivor where when there's a lack of growth everywhere, investors just go, okay, well, then let me go back to growth stocks, which is mostly tech right now. Now, I personally refine that further, and I suggest you want pricing power style tech. And that's where I like investing in the miners, so to speak, of pricing power artificial intelligence, which to me are high free cash flow companies that are potentially getting those big fat stimmy checks from the government, whether it's energy like an Enphase or autonomy plays or AI plays like NVIDIA. I think these are great opportunities, and I think those are the ones with pricing power. Now, some people say, oh, Kevin, it's Google, but I get really worried about Google, as we talked about in the course member live stream just last week, which remember, you can get lifetime access to those course member live streams linked down below. But the course member live stream just last week, we were looking at Google, and 69% of their revenues come from search. How the hell are you going to tell me that if 69% of Google's revenues vanish, Google's going to do good from AI? Now, yeah, they could grow their AI income, but you're starting at zero, whereas the big bulk of your income is advertising revenue based around search. But if AI replaces 50% of search, now you've just lost like 34-35% of your revenue. If AI replaces the need to ever use a search engine, you just lost 69% of your revenue. Good luck growing from there. Now all of a sudden you go from looking cheap and like a value play with your multiples to actually being a value trap, and people actually paying 5 times the multiple they think they are paying today. Scary. Things to keep in mind. Fundamental analysis is a lot more than just plugging data into an app and then looking at the app outcome and going, oh, the PE ratio looks good. Oh, yes, I will buy this stock because the ratios look good. Like the story also has to make sense around it. And it doesn't make sense for Google right now. It's not to say that Google can't float up with the rest of the equity market, but all in all, yeah, I mean, these are things that create nervousness. I personally think most of the inflationary concerns will be that we require more patience, but that we continue a downtrend. And these fluctuations in oil prices, I think, will be offset by the fact that oil prices and oil demand, rather, and natural gas demand has been declining since 2019. We peaked out in oil demand in 2019, and we're obviously trying to manufacture more or produce more. We can't produce as much as OPEC plus can, so we can't fully offset it. So we're going to have some price increases. But then the question is, how much of that is just pure speculation? Because if we do end up trending towards even a shallow recession, oil prices will probably have a lot more to fall. One of the reasons, by the way, you are seeing oil not do so well at the beginning of this year, and one of the reasons it had its worst quarter since April of 2020, which I realize that's a month compared to this first quarter, that was a magnitude drop, which was insane in April of 2020. The point is to compare this first quarter, and say it's been bad. Okay, it hasn't been this bad in a while for oil. One of the reasons is because the speculation that China's reopening was going to lead oil prices to surge and commodity prices to surge. I remember pounding the table in December going, that's bullcrap. It's not going to happen. Sure enough, it didn't happen. Now you have speculation. Okay, well now OPEC's cutting. Whatever. Eventually, OPEC will be irrelevant.
yes, in the near term, they're still very relevant. So yes, there is some headline inflationary impetus to this, and a lot of it, I think, is based off oil speculation. So it is a downside risk. However, and hopefully, it's transitory. Now, I don't like using that word, but it is entirely possible that the speculation of oil's going to 100, oil's going to 100 leads to short-term rally in oil. And then people start taking their tendies just like they should have done in January when oil kind of capped out before this quarter began. We'll see. All I know is this is a perfect opportunity to remind you to get life insurance in as little as 5 minutes by going to metkevin.com/life. You get lifetime access to those programs on building your wealth, linked down below, metkevin.com/join, or just go to meetkevin.com. You can see everything I got there, affiliates, the ETF I manage, the courses on real estate or stocks and site. And really, I'm sticking strong to my strategy. I put my money where my mouth is. I put my money all in my PP, pricing power stocks. And I think we're going to keep doing well. So we'll see. I'm optimistic. Hope you are too, and I hope we're right. All righty then. Now we've got to talk about Tesla. Although we do have the bell coming up here very soon. So we've got the bell coming up, and then we've got to talk about Tesla, and Kevin's hair is a little bit of a mess, but that's okay. There's a lot to talk about, but let me listen into Bloomberg for a moment. Good old Doomberg. Let's see what they have to say. We're going to go a little longer this morning. Of course, member live stream will be at about 7 a.m., and then hopefully I can fix my schedule. All right, let's listen in over here. This isn't working. I don't hear anything. Why not? That works. That's not very fair. I don't like that I cannot hear. No, that's a bummer. Yes. Is it just Doomberg that I can't hear? Let's see. Am I using the wrong button? This is not working. I will fix it. Audio. It is on. It says it is on. I have no sound. How am I supposed to listen to the bells then? I must fix it. Video, audio. That is quite strange. It is very strange. I don't know. Oh, well. All right, we'll have to do something else. Is it this one? Hold on a sec. No. How bizarre. Nope. I must have broken something. That's unfortunate. All right. Well, I'll just have to sing the bell myself. That is really odd. All right. I will try a different way. We will just go to shambishi.com and I will try it that way. And then that way we can at least listen to something for a moment. Yeah, that works. And I will try to fix that. Let's see here. If I press this button.
There's a separate deal with Peacock that was signed in 2021. So that's around for a while as well. They think they have a juggernaut. And they, Ari, in the way that he has tried to think of the properties they have now in the UFC, is going to try to leverage the whole thing into different areas, whether it's subscription or streaming. It's going to be interesting to see whether other streamers come out and trying to negotiate new deals as well, or if our parent company, NBC Universal and Fox, for example, re-up their own deals. There's a lot on the plate still to be done. Aside from all of that, they still have a new board to fill out. Right. There's going to be 11 seats. Endeavor's going to fill 6. WWE is going to fill 5. They have to fill out a lot of stuff, and then they're going to go public again.
Well, okay, so I mean, let's say people at home are trying to figure out what it's worth. There's a new co, and then there's an old co. What's old co?
Old co is Endeavor as we've known it, with right? all of the other
See, I always thought old co was really good, but it's never really gotten any valuation.
Well, Andrew was asking you which name you'd want to own going into this deal.
Oh, I know. I mean, look, I happen to love subscription business. This could be any subscription business that we're talking about. this is one of the stickiest. I know because a friend of mine who worked at the street worked there, and we were like at one point marveling that no one cancels. No one cancels.
Well, you know, we're in an environment where streamers are trying to take content and amortize it across the world, but you got language barriers. There are no language barriers with this.
No, and just think about it, right? And that's, I think, how everybody's trying to get their arms around it now. You got the UFC, you got the WWE, all now under one roof. You've got, two businesses that have excelled in live sports, which are the gold standard of television these days. And they think the power.
I'll figure it out. I cannot figure it out now. It is very annoying. We will talk about something else. So, all right. Well, then I guess we may as well talk about the next topic, which is Tesla. We'll talk about that in just a moment. And yeah, so that's my take on oil and the Fed. We looked at inflation. Let's go get a Tesla spreadsheet here. I'll play around with this. Somebody donated $10. Somebody donated I am a luxury rideshare driver. I fill up every day with some fuel. My largest cost by far. Do you see any relief for fuel prices soon? Well, no. I mean, no. Not with what we just had with OPEC. So no. Sorry. All right. Let's go over here. Okie dokie then. Let us talk Tesla. And we'll look at Tesla valuation a little bit as well. Okay, so let's get started. So Tesla just beat expectations for, well, some expectations. And see, that's one of the things that's really blurry about Tesla. See, here in pre-market, Tesla is actually red to the tune of about 3.3% after delivery numbers came out. Now, this comes in the back of Tesla being up 6.24%. Tesla was up 6.24% on Friday. Today, it's starting the day out down about 3.3%. Why is that happening? Especially if Tesla potentially beat. Well, the question is beat what? See, at least according to Goldman Sachs, Tesla reported Q1 deliveries of about 423,000 vehicles per quarter. That's up about 4% quarter on quarter and about 36% year over year. And that's with a production of about 441,000 vehicles. Now, that compares to potentially being roughly in line with the Bloomberg consensus estimates of deliveries at 421. Now, the question here is, was this consensus really what people were looking at? Or why is Tesla falling? Were people looking at a bigger, a larger beat? Or are people looking at more optimistic potential deliveries for Tesla? Or is it possible that this number right here is creating some nervousness for Tesla? Let's talk about that. So first of all, we look at Tesla as a growth company, and the goal for Tesla is to see growth between 30 to 50% year over year. And we've got a 36% year over year growth rate on deliveries here, which seems fantastic. But the problem is quarter over quarter deliveries only rose 4%. And in my opinion, that annualized rate of growth could be creating some nervousness for Tesla investors. Most Tesla evaluations and valuations are based on the idea that Tesla will have at least 30% EPS growth. But a 4% quarter over quarter bump in deliveries is not as exciting for folks as we would hope, especially following the January price cuts, which we now know are going to show up in margins in Q1. And we've known that since the last earnings report that we were, and certainly upon price cuts, that we were expecting to see some margin compression. But a 4% quarter over quarter annualizes. And remember, you don't go exponential here. You want to just simply go with multiplying by 4. 4 times 4 equals what? Well, it equals a 16% annualized growth rate. So it's entirely possible that the market is selling Tesla off after these delivery numbers because of an annualized growth rate that's actually not that fantastic. Now, look, don't get me wrong. Deliveries of 423,000 vehicles is great. It represents somewhere around 1.7 million vehicles per year, assuming no additional growth beyond this level. Obviously, we expect production to continue to grow, especially as Giga Berlin and Giga Texas continue to grow and ramp. And hopefully we end the year closer to, as Elon Musk sort of projected, around 1.8 million vehicles for the end of the year. Potentially, if all things go fantastically, maybe we can get to 2 million vehicles per year, but not at the rate where we sit now. At the rate where we sit now, we've got in the bag maybe about 1.7 million units, but the growth rate really matters for Tesla, because even if we get from 1.7 to 1.8, the concern is if the growth rate for Tesla has to start getting written down from, say, 30% to 16%, well, then the valuation for Tesla looks twice as expensive. Now, I'll show you exactly how this looks, and I'll give you, obviously, my opinions on this. So let's take a look. Let's go into a 2025 estimate for Tesla. So let's see here. If I press this button, there we go. I did it. I kind of messed up the little picture-in-picture thing because I've been messing around here. Hold on. Let's see if I can fix it. I don't know that I can. All right, whatever. We don't need picture-in-picture right now. So anyway, so what do we have? I haven't modified this yet after these numbers, and I don't know that I really need to. But if we project 4 million vehicles for at the end of 2025 with $47,000 of revenue per vehicle. Leases, by the way, are moving up. So these are coming in at about 5% now. So more people are leasing now. So I'm going to move this up to about 5% being leases. That'll change things slightly over here. Then we'll do total revenue from services. We'll grab that. And that actually does pump our revenues a little bit over here if more people are leasing, but we're still assuming these numbers here, unless, of course, leases potentially cannibalize some of those sales. That might be a little bit more adjusting to do, but relatively nominal here. If we sit at that 25% margin, which might end up being high, we might go as low as an expense here of around 80%, right? So if we sit at 75% expense, it's a little lower on leases. Then we're looking at probably a price target of around $531, assuming a 1.67 times PEG ratio at 30% EPS growth. So let me try to explain exactly what that means over here. So if you assume a 30% EPS growth, then the way you figure if that growth continues using a 1.67 PEG, then you could assume the company is selling for a 50 times PE ratio. Then you take the earnings and you multiply it by the PE. Easy. However, if that EPS growth rate plummets to, say, 15%, and you want to stay at a 1.67 PEG, well, now all of a sudden, you're only selling for a 25 PE ratio. Well, 25 PE, going back over here for a moment and changing this multiple to 25, halves the end of 2025 price target for Tesla. So you can see that this then would be 15% growth assumed on EPS. So I'm using 1.67 as a peg, by the way, because this is where I see a lot of tech companies generally do well. And I'm talking profitable tech, not profitless tech. Profitless tech would have an infinite number here because they don't have earnings, right? And some of the SaaS companies sit somewhere around 3 or 4 times on a PEG ratio. For a company like Tesla, mix of manufacturing and AI, 1.67 I think is very reasonable. Apple's actually a little rich, sitting closer to about 2.2 right now. So I think Apple's a little rich right now. Whereas Enphase is a little inexpensive right now, sitting closer to about a 1 PEG. Fine. But the point is, this growth rate is everything. This is basically the one variable you have to adjust. And that's what I like about using these formulas, is I just have to look at what's the growth rate for EPS. Well, if the growth rate for EPS halves, well, then you're looking at maybe a 265 future value for Tesla. If the present value of Tesla right now is $200, it's actually still not bad. That gives you a compounded annual rate of return of about 10%. That's not bad, even at half of the forecast, right? With just a 25 PE. It's not bad, but it's not what people are hoping for. People are really hoping for at least 30% growth on EPS, which would give you that 50 here, which really gives you closer to a 38% compounded annual rate of return. And that's really nice because that's a 2.5x in the next 3 years. That's fantastic. But again, the delivery numbers, in my opinion, that we just got here suggest an annualized growth rate of about 16%. And so that is potentially where markets are saying, okay, that's lower than we expected. Let's price in a little bit of pain for Tesla. That's not the only reason Tesla stock could be falling. And who knows, maybe it'll end the day up green. The market's funny. But the second thing that happens with Tesla is you have a lot of people who speculate on Tesla stock. So it's very possible that you ended up having a lot of potential buying before deliveries, and now you're having the potential profit taking or loss taking, depending on whatever position they took, but basically closing out those trade positions. Tesla is heavily exposed to retail traders, and so it's entirely possible that some of the fluctuations we could be seeing in Tesla price today could be trading. So if we look at this Goldman Sachs piece here, again, I think the biggest red flag is that EPS growth rate. It's a little on the slow side. We want to see that really pick up as Berlin and Austin ramp. But again, we're already expecting that. So any kind of miss on expectations just isn't good. If we look at Goldman Sachs' forecast, though, for Tesla, we can see here that they believe Q1 23 is consistent with the belief that Tesla is really prepared for long-term growth. That's great, but at what valuation, right? And the debates from here include, will Tesla have to reduce prices further? If so, how much? And if they make additional price cuts, how are those going to end up affecting margins? Bloomberg had a pretty detailed piece this morning about basically how the automotive sector is under a significant amount of stress because of high financing rates. It's been very expensive to finance a new car with a lot of rates over 6.5% now, potentially as high as 7.5% for a car. That makes owning a car very, very expensive. When I bought my Tesla Model X in 2017, the interest rate I got was 1.49%. My actual payment on that is mostly principal because the interest rate is so low. I financed the whole thing because the rate was so low. And my payment on it is $1,337, which is, I think, a pretty elite number, if I say so myself. But anyway, I haven't paid that thing off, even though there are only there's like 10K left on it because I'm like 1.49%. I ain't giving that up. That's just funny for the memes itself. But right now, rates are so much substantially higher to finance a vehicle. And that potentially adds more stress to people actually being able to buy cars like a Tesla. Now, if you look at the federal tax credit, hey, we had a great Q1 here, potentially boosted by the tax credits from the Inflation Reduction Act. But what happens when those tax credits go away? They were supposed to expire March 31st. Now they're expected to expire when? Oh, April 18th. That's great, but April 18th is only less than 3 weeks into the quarter. So what happens when some of those go away? Now, Tesla is buying down some of the interest rates on their vehicles. And if you put 10% down, for example, on a Model 3, you're looking at something like this right here, which puts you around a 5.6% APR interest rate. But again, that also is including some Tesla buy downs, I believe, which would hit Tesla margins. So continuing on here, margins TBD. Also TBD on what we think could happen in terms of actual earnings growth rates. But what do we have over here? We believe that with cost reduction drivers, this is Goldman Sachs here, Tesla can exceed a 20% non-GAAP automotive gross margin in Q1, and the margins will improve over the course of the year. Now, that's actually optimistic. Now, one of the things that I've talked about is that I think Q1 is going to probably be the worst set of margins for Tesla. And Goldman Sachs is reiterating that belief. Goldman Sachs is making the argument that, yes, Q1 could exactly be the worst quarter for Tesla in terms of margins. But if Q1 has the worst margins and then Q2 has worse deliveries because maybe the Inflation Reduction Act goes away, you do have some reason for fear ahead of you if you're trying to short-term play Tesla. I still maintain my belief that Tesla is one of the greatest pricing power plays that's available right now, because even in this disastrous environment, people are still buying an incredible amount of Teslas. It's insane when we consider that. So I'm optimistic about that. But I'm also cautiously optimistic. I don't want to come across as thinking that's it. Tesla's guaranteed going to the moon because, even though maybe that'll be true in the long term, I definitely think there's still potentials for pain between now and then. And that really makes me want to encourage folks to be careful with too much exposure or really any exposure to margin. So heads up. Now, one of the nice things is Tesla does still have nice cash flow. But the question is it going to last? Take a look at this. In Q4, Tesla ended up with this delicious capital or cash flow. Or let me start here in Q3. In Q3, Tesla had this delicious cash flow of $5.1 billion. That $5.1 billion was offset by about 1.8 in CapEx, which are like your factory expenditures, which brought you to about free cash flow in Q3 of $3.3 billion. Wonderfully insulated. That's very good. But that free cash flow already sunk in the fourth quarter, coming in at 1.42. So your free cash flow actually halved in the fourth quarter. And that's likely because we're ramping so heavily at Tesla, and margins are starting to get squeezed. When margins get squeezed, your operating income falls. And obviously, if you're still spending 1.8 billies per quarter, approximately, which has been roughly the trend here, you could see that right here, 1.8, 1.76, 1.73, 1.8, 1.85. Well, then the expectation is, we might go from free cash flow to potentially no free cash flow. So that is another risk factor for Tesla in the short term. Again, I still believe substantial amount of pricing power. And that's fantastic in this environment, and plenty of reasons for upside, but there's also reason for realistic caution. Now, do keep in mind as well that a lot of folks like to argue that Tesla has so incredibly much cash. They make this argument that, well, Tesla has $22 billion in cash, Kevin. Why are you complaining about potential free cash flow? Well, because if you actually go to the current liabilities, you can see they've got about $26 billion in bills to pay. I mean, if I just take payables and current liabilities, you're at 22 billies right here alone. That right there are the bills on the desk. And yeah, you got 22 billion in cash, but you got to pay the bills. So you got to keep operating, right? This is why really the balance sheet isn't as strong as people think. Yes, there's still free cash flow at this point, but we'll see how that goes, especially after Q1 margin. Margin comes in. So that's our near-term hit, Q1 margin. And then the next near-term hit is that $7,500 credit going to get halved for some models of Teslas? So we'll see. So definitely reason to be, not YOLO optimistic. I think in the long term, optimism on Tesla makes sense. I think there's a lot of pricing power, but we do want to get through this recession. And certainly, I believe that if we go into a shallow kind of baby short recession, I think growth will actually outperform because people will want to seek out that growth. Tesla will be one of those. If we go into a deeper recession, all bets are off and probably all stocks will do poorly. So that's something to keep in mind. But I do think there's substantial upside for Tesla. Once we get through this recessionary time, it's just going to require some patience. All right, that is my Tesla discussion. Sure. And now what else do we have? Let's see what else we have to cover today. So we talked about Tesla. We talked about the inflationary problem of oil. Now, I suppose we can do a little bit of a bearish piece. We're going a little bit deeper into JP Morgan. That might be worth it. No, that's a pretty good piece. Yes, Gasman here says, I worry it could be sub 20% gross margin. Yeah. Yep. Absolutely. Definitely possible that margin could be below 20%. I don't think it'll be substantially below 20%, but yeah, there's absolutely a risk. And then, of course, there's this question of how strong McDonald's pricing power is. McDonald's has a lot of pricing power over their franchisees. And I think that's where McDonald's is actually, that's the only reason I think McDonald's actually is a phenomenal company. I wouldn't invest in McDonald's right now because I think that pricing power is going to wane. Their ability to keep raising prices on their franchisees, I think, does fade. And that will not last. So we'll see. But we just heard about the McDonald's McDonald's corporate layoffs coming this week as well. So buckle up. They sent all their corporate people. I think they have somewhere between 130 to 150,000 people. They sent all of them home. And they said, all right, everybody work from home this week because we're working on layoffs and we want to lock the doors because we're worried about riots. Okay, they didn't actually say that, but they are expecting to do a pretty large wave of layoffs here pretty soon. So it'll be quite interesting. So, yeah. JR says, why are you talking about vehicle margins when operating margin is the only thing that matters? It's not actually the only thing that matters. The vast majority of Tesla's revenue comes from vehicle margins, not energy. And yes, energy could be a nice little tailwind to the future. And people are always going, Kevin. But if you take all of the icing on the cake and try to bake it into your fundamental analysis, you have no margin of safety left. And right now, revenues from energy are projected to be like less than 1% of total revenues. So, it doesn't make sense, in my opinion, to focus so heavily on energy at this point. Don't get me wrong. I think the Megapacks, batteries are going to be a phenomenal opportunity. The Megapacks for industrial or cities. And then, of course, home batteries. I think they're phenomenal. I think they're high margin. But do I think it's necessary to really triple down on this belief that, oh, let's just adjust the spreadsheet and yoink everything up on energy? No. I mean, even with the energy margins right now, they're at 82% cost. So your margins are even worse on energy right now than they are on the vehicles. So yes, in the future, will energy be a larger part? Yes, of course. But again, you start baking in all the icing on the cake in what I think is already a bullish outlook for Tesla. Well, then I think it gets to the level of ridiculousness where that you potentially get too euphoric over a stock and then you don't diversify to other stocks. So you want to be careful with that, in my opinion. That's why I like allocating maybe 20%, 25% of every dollar to Tesla right now if someone's investing. Obviously, that's not personalized financial advice for any individual. It's just sort of a broad suggestion. Does that potentially make sense? Sure. But I think the other 75 cents need to go into something else. So again, still heavily bullish, but not blindly bullish. Okay. Like hedged bullish, dare I say. Maybe we'll use that as a phrase. Hedged bullish. Hedged bullish. That sounds a little like Hezbollah. All right. Next. All right. JP Morgan. Okay. Let's see what we got. Oh, my Lord. All right. Well, JP Morgan just released a 194-page bear piece. Yes, 194 pages of being a bear about equities and about saying, we were bullish on equities in December. Sure. And then they happened to go up in January. Okay, JP Morgan, take all the credit. And now they say they're bearish. Let's take a look at some of the 194 pages and see what's leading them to be so pessimistic. Let's get started with page 3. And don't worry, I'm not going to page through all 195 pages because that could potentially lead to epileptic seizures with how many pages there are. And quite frankly, I'm not convinced that all of you have already gone out of your way to take 5 minutes and sign up for life insurance. Check out the sponsor. You go to metkevin.com/life and you can sign up in as little as 5 minutes. It's right next to the link down below to get 12 free stocks with Webull, metkevin.com/free. All right, what do we got here? So the main disconnect that the market will need to grapple with revolves around the hope for a soft landing without much pain to profits, labor, or credit, but at the same time, the expectation that inflation will come down. So in other words, JP Morgan starts the piece by saying, look, people are optimistic that inflation is going to come down without corporate profits actually falling a lot or unemployment going up. As a result, JP Morgan thinks that's basically ludicrous. It's too bullish. And therefore, they believe that stocks are going to weaken for the rest of the year. So this is the anti-Nike swoosh. I mean, this is like This is like the clickbait Nike swoosh, where you come down, you start forming the Nike swoosh, and they're like, yeah, no, we're going to do that. That's like the lightning bolt. We don't want the lightning bolt. We want the Nike swoosh. Their core view is that the activity upswing seen around the turn of the year was helped by falling gas prices in Europe and by Chinese reopening. However, that's unlikely to lead to a continued acceleration of growth in the second half. And as a result, they're bearish equities. They also think that excess consumer savings have been eroded. This is despite the fact that this is a JP Morgan piece, and Jamie Dimon doesn't think that for the lowest tier of individuals, the lowest income of individuals, the lowest income cohort, that their savings would actually be eroded until about Q3, which is what was one of the reasons why a lot of people aligned the idea that a recession could be around Q3, Q4, as savings actually start eroding. Bank of America obviously believed at the beginning of the year that people who had $5,000 in a checking account in 2019 today have like $12,000 or $13,000, substantially more savings than we previously had. So it's all going to come down to how much strength did the COVID pandemic really actually give us? Did it really actually strengthen us, or was it all fugazi? Anyway, we'll see. We held a view over the past 2 years that corporate earnings will be resilient, but this might start changing as profit margins are at a record and they may start turning negative. Now, they cast this as sort of a broad net here, right? It's entirely possible that those margins go down for non-pricing power stocks, which could be most of your staples and most companies. That's been my belief. But they're casting this pretty wide here, suggesting that the better option right now is actually international equity, that you should be overweight Japan, the United Kingdom, and insurance, but underweight the United States. They're also neutral on mining. They're neutral on tech. Very interesting. Neutral on tech, but underweight, which means bearish on the United States. Overweight defensive value, although they do see litigation risks for healthcare. This right here is actually one of the charts, in my opinion, that they're using to suggest this could be us. So this is when there was this real euphoria that, oh, China was basically going to go to the moon once COVID got removed. So you got this 57% rally in the MSCI China index, which is kind of like the S&P 500, but the MSCI version for China. Anyway, just think a basket of Chinese stocks, okay? Up 57%. And now, since the beginning of the year, well, probably about the end of January, as the reopening was progressing, actually down about 11%, which is very interesting. Then we've got, let me go to, I've highlighted in my opinion, the most salient pages here. And I want to go to just those. So what do we have over here? This gives you the correlation of plans to raise prices, or not correlation, this is just a survey on company plans to raise prices in the next 3 months. I think they're using this as a way to suggest that earnings might fall. I personally see this as a way to suggest that inflation is actually coming down quite meaningfully. Of course, we did just have a little bit of an oil shocker, which could potentially lead headline inflation to rise. But if we look at the Zillow rent index versus core CPI for shelter, you can see we still have had no adjustment in inflation from housing. And this is expected to come down. And there's expected to be about a 6-month lag between Zillow's rent index and when CPI actually comes down. So that remains to be seen, which is actually good because maybe inflation will come down and maybe inflation will prove to be transitory, but not if earnings end up getting crushed, because then that ends up creating more pain. Here's that natural gas pricing in Europe, which could have fueled some rallies. And then over here, let me go to the next one. Hold on. There's so many pages here. I really just want to get to some of the core ones that I marked up. Here, you could see job cuts skyrocketing. Announced job cuts. Now, I think this chart is actually pretty neat because rather than waiting for that lagging unemployment report, it really gives you this idea of, hey, look, generally, when job cuts spike, we're in a recessionary environment. Look at that. Every time this little red line that I just drew goes up, recession. And it's likely that we're going to see that sort of softish, at least a shallow recession here, which doesn't necessarily have to be a soft landing. Some people say that any recession is not a soft landing. But anyway, this is a fair indicator here that yes, job cuts are here. Now, some people counter this and say, hey, yes, we know the inverted yield curve has never been wrong in history. And yeah, we're probably going to hit a recession, but maybe we could survive that recession with pricing power stocks. That's one argument. Or another argument is that, hey, people have enough savings. And the reason we're seeing these job cuts is really for companies to increase their margins so their EPS growth can essentially maintain a growth, a level of growth, which could actually help EPS and valuations hold through any kind of shallower recession. I maintain that if we go through a harsh and deep recession, all bets are off. Stocks will do poorly. But JP Morgan also uses this US savings rate. I think it's very convenient that they could have 194 pages of bearish charts and not include any kind of charts on how much household savings are actually higher right now than they were in 2019. And instead, they just show us the savings rate, which, yes, we know the savings rate has gone down. Interestingly, though, it's actually starting to tick up again. In the last personal consumption expenditures measure, we actually did see personal savings rise again, which was good. And then, of course, here they argue that the lag time between the lowest unemployment rate and the next recession is surprisingly short. Now, this was quite an interesting chart. It's not a chart that I've actually paid attention to before or really have analyzed before. And I do think it's interesting that, look at this. Basically, the lowest unemployment rate on the chart always comes right before a recession. But then again, I kind of look at this as like, the question of causation and correlation. Doesn't it make sense that the lowest unemployment rate would be right before a recession, because a recession is defined by increasing unemployment? So, of course, you're always going to have a lower rate right before a recession. I don't know necessarily that means this low is bad, right? Because in theory, and it's not necessarily the case, but in theory, just to sort of make an argument here, is it not possible that this could continue trending down? And then let's say a recession is over here in 2030 or something like that. And then that's actually where you draw the circle, right? We don't know that for sure it's going to be here. We assume it would be because there have been so many layoffs announced recently, but who knows? To some extent, by some measures, it seems like the job market still has some strength to it. I'm not necessarily making that argument. I do think the unemployment rate is likely to tick up, in which case, then, yeah, there's our shallow recession potentially. We'll see. So I do think the recession coming is a reality. How deep it is, that I think is more important and requires some betting. So let's go to another one I highlighted. I saw this and I'm like, no, they're saying the PP will shrink. Pricing power will be lost. This is what they're doing here is they're saying global EPS. So they're not solely looking at pricing power stocks. They're looking at all stocks. And they're saying, we think all stocks as a whole will ultimately be in a situation where you're going to get the halo announcer saying,
lost the lead.
Yeah. Now, hopefully, individual stocks that have the highest amount of pricing power, which is my investment thesis, will continue to be in a position of, it didn't work. Why is my button not working? My button's not working. Something's wrong with button number 3, but it's supposed to be gain delete. I screwed up my board, I guess. I'll fix it. But anyway, profit margins are at record highs right now and can trend down fine. Let's keep going. So here's the next one that I highlighted. This is on page 43. Activity momentum stabilization seen in the last 6 months might be done. The driver of a sustained expansion is missing. They're basically saying, hey, look, we kind of got lucky maybe with EPS holding up because companies were able to shave off the from the edges to increase their margin, and people were able to spend through the pain up until now. But that could end up going away. And when it goes away, we're potentially going to face even more problems. So JP Morgan, not very optimistic here on a lot of their various different metrics over here. You also have this gold to copper ratio, which I think is an interesting chart as well. This is on page 180. They talk about how when when gold prices move up relative to copper prices, it's generally a recessionary indicator. That's because gold is a fear metal, whereas copper is a production metal. So as production goes down, copper prices go down and prices of gold go up, which increases the ratio. As the ratio increases, this line goes up. And they suggest that we're actually approaching another fear peak on the right over here. And that would align with potentially a recessionary environment, which makes sense because, again, people fleeing to gold creates fear where people are like, okay, maybe we need to spend less money on stuff and actually start saving money. Well, cash is trash. So let's save money with gold. That's an idea. Now, at the same time, we're also seeing semiconductor inventories, which have done this. Of course, they didn't really give us much detail as to whether or not they flow into 2023 over here, because I do think, yes, global semiconductor inventory has skyrocketed, but I think it's come down, although they don't show that in the chart here. It is eerie, though, to compare it to the dot-com bubble, because you look at those global semiconductor peaks over there. Yikes. Dot-com bubble is not what we want to compare to, especially since stocks came down 3 times as fast this time compared to the dot-com bubble. I think the last thing you really want to do is compare to the dot-com bubble, because that was a 3-year crash. We've already been through a 1-year crash, and it's painful enough. Do we really want to go through another 2 years of this hell? Absolutely not. No way, Jose. So anyway, they're actually still, I'm blown away by this. They're actually optimistic on staples, specifically European consumer staples. They say staples valuations are less challenged and could still hold up. I personally doubt that. I think that's wild. Now, we did also just get some data out on ISM prices paid, which was somewhat of a catalyst we could look at. We could see, hey, what's data from a minute ago look like, and how does it compare to what JP Morgan is saying? Well, ISM prices paid. Oh, wow. That's actually fantastic. ISM prices paid. The expectation was 51.1 versus 51.3 in the prior. We actually came in at 49.2. A number under 50 is a price contraction, which is good. That's actually fantastic. That's great news. Construction spending came in at negative 0.1%. We were expecting 0. So that's good to some extent in terms of pricing, nominal pricing. S&P Global Manufacturing PMIs came in slightly below expectations, though, at 49.2, also in contractionary territory, dare I say recessionary territory, compared to the 49.3 expected. But that price is paid on ISM. That's fantastic. That's really good. Now, the market hasn't really reacted to this too heavily, mostly because the NASDAQ is bouncing around down about somewhere around 0.5%. A lot of that is due to the give back at Tesla today, because you had that 6.5% rally on Friday, and you're getting the give back today with it now down about 4.4%. So continuing to look at the JP Morgan page, they are neutral here on consumer discretionary, and they specifically point out autos as being vulnerable to a consumer slowdown. So red flag here for autos. It's unclear if that would be a red flag for all autos or just specifically average autos, right? Because obviously Teslas, as an example, cater to a higher income audience, with the median income being over $110,000 for a Tesla customer. Also, this Tesla customer is still predominantly male. Expect at some point, maybe if they have a little bit more of a mommy-friendly car, that might change. I really think they need some kind of van, like a Sprinter-style van. I think that'll come. Anyway, U.S. small caps look cheap, says JP Morgan. However, some say Morgan Stanley released a paper this morning and said, look, small caps going cheap is actually a red flag that the recession is knocking on the door. When small caps start looking cheap, it's a sign we's going down more. So you kind of have a little bit of balancing to do there. Now, a lot of this JP Morgan piece, probably 50% of this JP Morgan piece, focuses heavily on Europe and different sectors of Europe that they think are expensive. I personally like looking at the U.S. sectors. Here's another potential page here where they show U.S. equities exhibited a significant growth tilt. U.S. leadership over other regions has been consistent with growth outperforming value and tech outperforming banks. And see, I agree with that, because I specifically think that growth, especially pricing power stocks, are the safest. But I don't want to sound redundant. I want to specifically look at the counter theses. And again, they're neutral tech. JPM is actually bearish stocks, but neutral tech. That's very interesting. So overall, JP Morgan not very happy. They think stocks are going to go down for the rest of the year. Now, this comes at the same time as U.S. positioning in stocks isn't that great. The allocation to stocks is pretty low. By some accounts, it's the lowest that we've seen since the dot-com bubble. And maybe that could actually lead to some kind of rebound or continued Nike swoosh growth in stocks. We'll see. But this is JP Morgan's take. I want to know what you think. Let me know in the comments down below what you think about JP Morgan's take here. Bearish equities overall. It seems like if you believe in what JP Morgan is saying, maybe the best thing to do is just sit in cash and wait for opportunities. Of course, I think the best opportunity coming ahead of us that's still to come when it comes to sitting in cash is buying real estate. I'm really convinced that most people watching this stream could become millionaires, no matter what your job is, could become a millionaire through investing in real estate. That's why I have a program that shows you how to do that step by step called the Zero to Millionaire Real Estate Program. I encourage you to check that out. Link down below. Comes with lifetime access to all the course member live streams and the lectures on building your wealth, which those are fantastic because you get that overall long-term added value of the fundamental analysis that we could do in the course member live streams, as well as the recorded lectures. So check those all out via the links down below, next to the links for life insurance and 12 free stocks with Webull. I got to run on over to the course member live stream now. Thank you very much for being here, and we'll see you in the next